Welcome to the research desk.
Glad to be here.
So, if you are building your portfolio today to survive an oil embargo, you're already completely exposed.
Oh, absolutely.
We are looking at a market that is aggressively preparing for the 1970s, assuming the next great systemic shock will perfectly mirror the past. And that assumption is what we have to dismantle today. The core tension we are analyzing is whether that 1970s macroeconomic playbook still provides the correct regime map for today's market.
Right. Or if the underlying architecture of global trade has fundamentally mutated.
Exactly. I maintain that the macroeconomic machine itself has not changed. The transmission mechanism of a supply shock, how a constrained physical input violently ripples through supply chains, forces wages higher and, corners central banks into crushing demand, that remains exactly the same today as it was half a century ago. The specific geopolitical trigger may shift, but the cascade of economic consequences follows a strict mathematical sequence.
But applying that 1970s playbook literally is a sophisticated trap. Preparing for a historical crisis ensures you will be fatally late to the actual disaster unfolding in front of you.
You really think it's a trap?
I do. You are right that the transmission mechanism rhymes, but the literal bottlenecks have entirely migrated away from crude oil. The modern choke points, the vulnerabilities that will actually dictate the next systemic inflation shock, are hidden in Taiwanese semiconductor fabrication plants, interconnected natural gas pipelines, and maritime shipping lanes.
So you're saying the consensus is just looking in the wrong place.
Exactly. If you sit back and wait for a crude oil embargo to signal an inflation shock, you will completely miss the systemic repricing. You will be holding the wrong assets while the actual scarcity rents accrue somewhere entirely different. We have to identify where these new vulnerabilities lie before the market consensus catches up to the reality of the modern grid.
Well, to understand why the consensus is so anchored to oil and to identify what a true critical input shock looks like, we really have to forensically examine the historical data from the 1970s and 1990.
The base rates.
Right, the base rates. These events are not just history. They establish the undeniable baseline of systemic disruption. So let's start with 1973. The OPEC embargo removed a critical volume of crude from the global market. The price of oil quadrupled, from $2.90 to $11.65 a barrel.
Which is just a massive overnight repricing.
It really is. So what actually happened? Think about this for a second.
Pause.
We are not talking about a frustrating increase at the fuel pump for consumers. This was a violent overnight repricing of the primary physical input of the entire industrialized world. The economic damage was immediate and it was structural.
Unemployment shot up, right?
Yeah, it peaked at 9%. The United States economy shed 2.3 million jobs. And for allocators, the reckoning was absolute. The S&P 500 collapsed by nearly 50%.
50%? That's a genuine crash.
A total crash. And the sheer violence of this equity repricing happens because the supply shock attacks equity duration from two directions simultaneously.
The double whammy on cash flows and discount rates.
Exactly. First, the soaring cost of inputs destroys your operating margins, which impairs your future cash flows. Second, the resulting inflation forces interest rates higher, which violently raises the discount rate applied to whatever cash flows actually manage to survive. You are crushed mathematically from both ends.
And the 1979 Iranian Revolution provides an even sharper clinical study of that exact mechanism. The geopolitical rupture there was absolute. Iranian output collapsed by 92%.
92%. That's almost total removal from the market.
Right, we're talking about 5.8 million barrels per day simply vanishing from the global market, reduced to a mere 445,000 barrels. That is an absolute supply vacuum. It pushed oil toward $40 a barrel, but the secondary effects are where the true economic trauma occurred.
The inflation shock.
Exactly. The consumer price index broke above 13%. That specific inflation metric forced Federal Reserve Chair Paul Volcker to raise policy rates to 20%. Pause. Consider the mechanical impact of a 20% cost of capital on an industrial economy.
It would freeze everything.
It completely paralyzes corporate investment. You cannot justify building a new factory, financing new inventory, or expanding a workforce when the hurdle rate on your capital is 20%. The system freezes. And we saw a highly concentrated version of this again 11 years later.
In 1990.
Yeah, 1990. The Iraqi invasion of Kuwait pushed oil from $17 to $46. While that specific shock was shorter in duration, the economic scarring was incredibly concentrated. Over just 20 months, 1.5 million jobs were lost, and 90% of that destruction was isolated strictly within the manufacturing and construction sectors.
That is fascinating. What is really striking about these three distinct events is that they created cohorts of winners and losers that repeated with uncanny consistency.
The scarcity rents really dictated everything.
They did. The winners across those three distinct shocks demonstrate the sheer power of scarcity rent. Energy was the most obvious beneficiary, with oil rising roughly 1,000% across the decade, from $3 to $40. But look at how capital sought refuge.
Gold, right?
Yes, gold operated as the ultimate fiat hedge, skyrocketing 2,200% from $35 to $800 an ounce.
Oh, wow. 2,200%.
Yeah, and we have to understand the mechanics of why that happens. When a critical physical input becomes scarce, the cost of producing everything rises. If the central bank prints money to accommodate those higher prices, the currency fundamentally degrades. Gold absorbs that inflation mechanically because its supply is fixed while the denominator, fiat currency, is expanding.
And farmland performed similarly, didn't it?
Exactly the same function. It compounded at approximately 14% annually, rising from $137 to $737 per acre. For investors who utilized standard leverage, those annual returns approached 25%.
That is incredible for an agricultural asset.
Real estate investment trusts delivered 6.5% real annual returns as well. But not all real estate works in this environment. Those returns were entirely driven by REITs utilizing short-term leases.
Because you need to reset the rents.
Right. If you own an apartment building with one-year leases, you can systematically raise rents every 12 months to capture the inflation premium. If you are locked into a 10-year commercial lease, your real return is eroded to zero.
And the losers in that environment were equally predictable and, structurally compromised by the exact same physics. The automotive sector was decimated. Total vehicle sales fell by 11%. General Motors was forced to close 16 manufacturing plants, resulting in the layoff of 105,000 workers.
105,000 jobs. Just staggering.
Yeah, and Chrysler shuttered 10 plants. The airline industry watched jet fuel consume roughly 15% of their total operating costs, systematically eradicating their profit margins.
Because they can't just pass that cost on?
Exactly. This happens because these businesses operate with massive fixed costs and possess virtually zero pricing power. When an airline's primary variable cost, fuel, quadruples, they cannot simply quadruple the price of a passenger ticket. The consumer would simply stop flying. So the business is forced to absorb the input shock directly into its own margins, which destroys its equity value.
Which brings us to the core thesis of how we navigate today. History is useful not as a script but as a regime map. The persistence of these exact cohorts, energy and real assets aggressively outperforming, while highly cyclical, energy-intensive sectors collapse, is the foundation of the continuity argument. The macroeconomic sequence operates like a physical law.
Walk us through that sequence.
Okay, step 1, a geopolitical rupture occurs. Step 2, an indispensable physical input is constrained. Step 3, the spot price of that input spikes. Step 4, headline inflation rises immediately as the raw material cost flows into the system.
And then the infection spreads.
Right. Step 5 is where the real damage happens. This primary inflation inevitably infects core inflation through second-round effects. The soaring cost of diesel bleeds into the transportation cost of every single good on a grocery store shelf. Labor unions see their cost of living rise, which catalyzes aggressive wage demands.
Which leads to step 6.
Step 6, central banks are forced into a corner. They must tighten monetary policy, or the bond market will tighten financial conditions for them by selling off long-duration treasuries. Step 7. Corporate margins compress because most businesses lack the pricing power to pass these extreme compounding costs onto the consumer.
Resulting in the final stage.
The final stage of this sequence is mandated demand destruction. The system literally has to break consumer demand to meet the newly constrained supply.
And that sequential chain is precisely why the macroeconomic machine remains intact. I mean, we are in total agreement on the transmission mechanism. A supply shock is never just a spot price event. It is a full system repricing.
A full system repricing.
Yes, higher oil prices in the 1970s fundamentally altered the mathematics of global trade. They shifted consumer behavior permanently, they rewrote labor contracts, and they forced a severe compression of valuation multiples across all equity markets. But we have to factor in the modern amplifier.
Globalization.
Exactly, globalization. The transition to a globalized, just-in-time economy was brilliant for corporate efficiency during 3 decades of geopolitical calm. It stripped massive inventory holding costs out of the system. Companies stopped holding 3 months of buffer stock in warehouses and relied entirely on perfectly timed shipping logistics.
Which is great for margins when things are calm.
It is incredibly accretive to profit margins in calm waters. However, just-in-time logistics are extraordinarily brittle under stress. We have not eliminated concentration risk in the modern era. We have simply spread it across entirely new nodes.
Exactly. The vulnerabilities have migrated away from crude oil and into natural gas pipelines, liquefied natural gas export terminals, and highly concentrated semiconductor fabrication facilities. A localized disruption in one of these critical nodes now propagates globally at light speed because the system lacks any buffer inventory to absorb the shock.
And that migration of vulnerability is exactly where the 1970s playbook becomes incredibly dangerous if you apply it literally. The consensus assumption right now among asset allocators is that the next geopolitical rupture will manifest as another crude oil shock. We have to completely shatter that assumption.
So what's the evidence that breaks that assumption?
Look closely at the data from Europe in 2022 following the invasion of Ukraine. Every macro tourist in the market was obsessively watching the price of Brent crude, waiting for the 1970s to repeat. But crude was not the actual bottleneck.
It was natural gas.
Yes, the critical constrained input that broke the system was natural gas. The benchmark Dutch TTF natural gas price surged above 300 euros per megawatt hour. Pause, let that figure sink in for a moment. At 300 euros per megawatt hour, the baseload cost of industrial civilization breaks.
It's just an unbelievable number.
It is. Factory curtailment swept across the entire European continent. Massive chemical plants, steel mills, and heavy manufacturing facilities simply powered down. They turned the lights off because operating at those input costs guaranteed catastrophic financial losses on every unit produced.
Because the cost of production exceeded the value of the output.
Exactly. And yet, despite the trigger moving entirely from crude oil to natural gas, the vintage transmission mechanism reappeared flawlessly. ExxonMobil posted a record $55.7 billion in profit for that year.
$55.7 billion? That is staggering.
It really is. The scarcity rents were absolutely immense, but they accrued because of critical natural gas infrastructure and refining capacity, not because of a Middle Eastern oil embargo. The bottleneck moves.
That is a staggering realization. The trigger set has broadened tremendously. The 1970s were defined almost exclusively by state-on-state disruptions in the Middle East that specifically targeted crude oil. But, the modern economy is vastly less oil-intensive per unit of GDP than it was 50 years ago, and it is heavily weighted towards services.
The vectors are completely different now.
Right. The macro-relevant shocks of this era emerge from completely different vectors. We are no longer just looking for a canker crisis in the Strait of Hormuz. We are looking at state-sponsored cyber attacks that can take down regional power grids. We are looking at punitive export controls on the rare earth metals required for battery manufacturing. We are looking at the explicit, intentional weaponization of supply chains by sovereign actors.
And the Ever Given incident in March 2021 perfectly illustrates this broadened trigger set.
Think about what actually happened there. A single container ship, caught in a dust storm, grounded sideways in the Suez Canal.
No state actors involved at all.
None. There were no oil ministers meeting in Riyadh to dictate production quotas. There was no explicit embargo. There was no conventional geopolitical conflict whatsoever. It was simply a physical breakdown of linear global inventories.
That single haul blocked an estimated $9.6 billion of goods per day.
Almost $10 billion a day.
Yeah.
It paralyzed automotive factories in Europe because they couldn't get basic wiring harnesses. It delayed critical electronic components bound for North America. It proved conclusively that modern systemic inflation can emerge from nothing more than a congested shipping artery.
So the fragility is everywhere.
The shape of fragility has widened far beyond the energy sector. We are dealing with an economic system that relies on invisible, highly optimized pathways. And when one pathway is blocked, the inflation impulse is just as severe as a traditional commodity shock.
You know, the psychology of these modern disruptions requires a total shift in how we conceptualize market fear. Think about the psychology of 1973. It was incredibly simple. The 1973 oil shock was akin to the original movie Jaws.
Jaws? How so?
Well, there was one singular, terrifying, universally understood threat in the water. Every investor, every consumer, and every policymaker knew exactly what the shark was, where it lived, and the immense damage it could inflict. When crude quadrupled, the panic had a single identifiable face.
That makes sense.
But today, the macroeconomic water is teeming with diffuse, unseen predators. The vulnerabilities are distributed across liquid natural gas export terminals in the Gulf of Mexico, cobalt refining concentrations controlled by single nation states, and fragile maritime shipping lanes that can be shut down by drone strikes. The fear is less singular. It is harder to point to on a map, but the bite to an investment portfolio is equally fatal.
And, the most critical variable in this modern regime is not actually the macroeconomic shock itself. It is the wild card of the modern state.
The government response.
Exactly. If you are analyzing a supply shock today, you have to ask one fundamental question: who actually gets to keep the scarcity premium? In the 1970s, scarcity translated directly and cleanly into massive corporate profits for the owners of the constrained resource. If you owned the oil, you kept the windfall.
But today?
Today, governments act as immediate circuit breakers. Modern states reflexively intervene in the market the moment a critical input spikes. They deploy strategic petroleum reserve releases specifically designed to manipulate spot prices and crush the momentum of commodity traders. They implement windfall profit taxes on energy producers to confiscate the scarcity premium. They mandate strict consumer price caps and distribute massive subsidies.
Like we saw in Europe.
We turn to that European gas crisis of 2022. Dutch TTF at 300 euros per megawatt hour, if left to pure market forces, should have completely destroyed European consumers. It should have pushed millions into personal bankruptcy and enriched energy producers to an unprecedented, almost feudal degree.
But they stepped in.
Instead, governments intervened with historic fiscal emergency packages. They socialized the downstream pain by absorbing the cost differential onto the sovereign balance sheet, preventing a total collapse of consumer solvency. The investment game has fundamentally changed. The dominant question for an allocator is no longer who owns the scarce asset. The dominant question is who can monetize the scarcity before policy rewrites the payoff.
When you put all this together, it forces a complete overhaul of portfolio construction. The 1970s playbook works flawlessly at the macro level. The sequential transmission mechanism, from input constraint to margin compression to demand destruction, remains entirely intact. But that exact same playbook fails utterly at the asset allocation level unless it is expanded into a comprehensive critical input playbook.
The topology has changed.
The topology of the economy has changed, and we must map the new interdependencies. If you are managing money right now, your next move has to be highly specific. Let us walk through the exact portfolio recommendations required for this environment. First, we must overweight selective scarcity beneficiaries by exactly 7%.
7%?
Yes, 7%. This exposure should be expressed through broad, highly liquid vehicles, such as the Energy Select Sector SPDR Fund ticker XLE, and the iShares U.S. Aerospace and Defense ETF, ticker IDA. Alternatively, investors can utilize integrated supermajors with absolute fortress balance sheets. That's €300 megawatt-hour gas price and Exxon's $55.7 billion profit prove that scarcity rents still accrue with staggering speed when a system choke point is breached. We allocate this 7% overweight because the historical base rate of energy and defense outperformance during a supply shock is quite literally the most reliable signal in financial history.
But overweighting energy is only the offensive side of the trade. Second, portfolios require substantial structural exposure to inflation-sensitive real assets. This is the mandatory defense against currency debasement and central bank policy errors.
What specifically goes into that bucket?
This allocation demands physical gold, broad agricultural commodities, direct farmland-linked vehicles, and REITs specifically structured with short-duration leases. The math from the 1970s base rates is simply too powerful to ignore. Gold returning 2,200%, farmland compounding at 14% annualized. These assets do not merely survive inflation, they metabolize it. They take the expansion of the fiat monetary base and translate it directly into real price appreciation.
That makes perfect sense for defense.
Third, we must heavily favor pricing power over raw cyclicality. This means taking a distinct overweight in consumer staples and healthcare. These sectors possess defensive demand profiles. Their products are biological or societal necessities, food, basic medicine, hygiene products. These are not discretionary purchases that a consumer can simply defer when their utility bill spikes. Because of this inherently inelastic demand, their pass-through mechanics are incredibly strong. They can pass the rising cost of their own supply chains directly to the consumer without collapsing their underlying sales volumes.
Fourth, to find these overweights, we must ruthlessly underweight brittle, energy-intensive, and just-in-time businesses by 3% to 8%. This is where the structural losers of the modern regime reside. We are systematically avoiding legacy automotive manufacturers, commercial airlines, and highly cyclical discretionary retail.
Because they lack that pricing power.
Exactly. The historical precedent here is brutal and uncompromising. Remember the 105,000 GM layoffs in the 70s? Remember that an airline's operating margin is structurally held hostage to the price of jet fuel? If a business requires perfectly timed, frictionless global logistics and continuously cheap energy simply to maintain its baseline operating margin, it must be stripped from the portfolio the moment a critical input shock registers.
Fifth, we must establish rigorous quantitative unwind signals. Scarcity trades are highly volatile, and they work best during the acute acceleration phase of a crisis. You do not hold these overweights permanently, because supply eventually incentivizes substitution or the state intervenes.
What are the exact signals?
We reduce the scarcity overweight explicitly if Brent crude sustains below the $65 to $70 per barrel threshold. We reduce exposure if European or U.S. natural gas futures drop roughly 20% from their crisis peaks. Crucially, we sell the overweight if global crude inventories rise more than 5% for 2 consecutive months.
Why those specific metrics?
Because they mathematically indicate that policy intervention and demand destruction have successfully broken the price spike. The fever has broken, and holding the scarcity asset beyond that point means holding a depreciating rock. Sixth, investors must track the policy response, not just the spot prices. The investable move is often found in the secondary government reaction.
Right, watching the state's hand.
We must monitor wage transmission data to see if labor is successfully demanding inflation-matching raises. We have to track strategic petroleum reserve depletion rates. We must monitor the legislative progress of windfall profit taxes. The state, not the spot market, ultimately determines whether a supply shock becomes a multi-year regime or a transient 2-quarter squeeze.
Seventh, and finally, we must aggressively expand the physical watch list. The dashboard of the 1970s featured only 2 dials, crude oil and gold. If you are running that same dashboard today, you are flying blind. The modern dashboard must actively track liquefied natural gas shipping rates. It must monitor the operational status and reserve capacity of regional power grids.
And the semiconductors.
Right. It must track the lead times for advanced semiconductors because the delay in a Taiwanese fab halts automotive production in Detroit. And it must monitor the inventory levels of transition metals like copper, lithium, and cobalt. The true edge in modern asset allocation is identifying which critical input is becoming systemically non-substitutable, right before the broader market recognizes the vulnerability.
The assumption that oil crises are exclusively about oil guarantees a failure to protect capital. The true value of studying the disruptions of 1973, 1979, and 1990 is recognizing the underlying physics of the event. Any impaired critical input can now play the exact same macroeconomic role that crude oil played 50 years ago.
The physics are identical.
Exactly. Whether it is shipping capacity blocked by a single grounded hull in the Suez Canal or natural gas constrained by a pipeline shutoff in Eastern Europe, the downstream margin squeeze and the resulting inflation impulse operate on the exact same physical laws. Focusing obsessively on the commodity named in the historical headline ensures you will completely miss the actual disruption unfolding in the present.
So we're actually looking at the exact same conclusion here regarding the architecture of the modern economy. The 1970s remain highly predictive precisely because they reveal the enduring macro logic of scarcity. When a critical input is impaired, regardless of what that input is, inflation rises, central banks are forced to tighten, economic growth slows, and capital aggressively flees toward businesses with unassailable pricing power, hard physical assets, and geopolitical beneficiaries.
That is the core of it.
What is fundamentally changed is the geographic and structural location of the bottleneck, combined with the unprecedented speed and scale of state intervention.
The investor who merely asks whether current events represent another oil shock is asking the wrong question entirely. They are matching superficial patterns without understanding the underlying mechanics. The real lesson of the 1970s is not that oil shocks repeat. It is that markets consistently keep mistaking a changing bottleneck for a changed world.
Investors who prepare for the last crisis literally will be late. Investors who understand the transmission mechanism may still be early. So as we watch global supply chains reorganizing in real time, ask yourself, what is this cycle's oil?
This is the research desk officially signing off.